Hello guys, welcome to Trading X-Ray. In this video, today we will talk about stock market basics, and the chapters we will cover in this video are market structure, risk management and capital management, crypto market and forex trading, trading style, technical analysis versus fundamental analysis, beginner's trader versus pro trader. So watch till end and let's begin. After watching this video, you will become capable of finding relevant and irrelevant things related to stock market. Suppose if we buy some shares from any company and company get profit, then we also get profit, and if company get loss, then we also get loss. But stock market works in a channel, and we have to know the whole market structure, how the different components of stock market interact with each other. Then you will understand the overall story of stock market. Suppose there is a company ABC, and he needs funds to expand his business, but he don't have funds, so he have to acquire funds through his friend, relatives or any other helpers. But no one no one will give money to him as for free of cost. They also need some sort of partnership, and then the company ABC will establish partnership between them, and the overall profit of the company will be shared equally among the partners. Even if they get profit or loss, everything will be shared equally. That's the main concept of partnership. So the same thing happen in the stock market, but in a very systematic way. Whenever you buy any shares from any XYZ company, then you actually doing a partnership with that company. Even the percentage is very small, but you are the part of that company if you buy a single share of that company. So if any company wants to list in stock market, then he has to contact with SEBI. SEBI is the government authority of India which regulates the rules regulation regarding stock market, the company listing and stock exchange and broker and retailer. It controls everything related to stock market. If all the rules and regulation was followed by the company according to SEBI, then it is eligible to get listed in stock exchange. And this whole process is known as IPO. Stock exchange. This is the main hub of the stock market, and every channel finally meets to the stock exchange. In India we have BSE, Bombay Stock Exchange, NSE, National Stock Exchange. Both are almost equal, but NSE have a much greater volume and have FIIs and DIIs as the investors, and all top good volume company is listed in NSE. India has almost 5,000 companies with combined BSE and NSE, and these 5,000 companies are allowed by SEBI. But if you want to trade on those companies, you can't trade directly from stock exchange. You need broker like Alice Blue, Angel Broking, Zerodha. These broker creates demat account of yours which is connected to your bank account, and then they all link demat account, trading account and bank account with stock exchange and SEBI. After linking to SEBI, then you are ready to take any trade from those company which is already listed in stock exchange. It doesn't matter you get profit or loss, you have to pay some commission as a brokerage to broker, SEBI and government. Your every trade is recorded and sorted in SEBI. So in every condition you have to pay some brokerage. So your profit must be greater than brokerage, otherwise your trade will be nothing, will be useless. When all the setup recording regarding to your account is ready, then you can take trade from mobile or laptop or even with phone call. Index. Index is actually a collection of top performing companies of a particular segment. In India, we have mainly three index: Sensex, which is a collection of top performing company of Bombay Stock Exchange. Then Nifty 50, it is a group of 50 companies from NSE, and then Bank Nifty. This consists of list of high volume banks. These three index always move in a same direction. It very uh, it happens very rarely that Nifty and Bank Nifty goes in opposite direction, but most of the time they all move together in a single direction. These index also represent your country GDP and performance. Same happens with all countries around the world. They all have different index, and those index represent their country's economy. In India stock market, we have four segments. First, cash, future option, then commodity and currency. Once your account is ready, then you can trade in any of those segments. But you must know what is the difference between them and which is safe and which is risky. If you talk about the cash segment, which is the safest segment among all because it has a circuit limit of 20%. It can't move beyond 20% upside or either downside in a single day. That's the rule of SEBI to protect your capital. It means whatever happens, your maximum loss will be 20% in a single day, same as your maximum profit 20% for a single day. But the company listed in cash moves very slowly. They rarely gives to 2 to 5% profit, and mostly company goes in a side trend. But the story of future, commodity, currency and options are totally different. In this segment, you can get profit almost 300% in a single day, as well as 0% in a single day, as well as wiping your whole capital in a single day. And they also work in lots, so you can't buy a cheap lot because the base price of lot is fixed and minimum price of the lots are around 30,000 to 1 lakh. So it means that future option commodity currency is also risky and as well as expensive. So for the beginners trader, they must stick to the cash segment, and only and if they get a good profit in cash segment, then they can move in future option commodity or currency. Until then, they must protect their capital and stick to the cash segment. Now we will talk about segment wise capital and their profit. Profit percentage will be calculated monthly. Cash segment required capital around 20,000, and you can earn up to 5% to 30% per month. As you already know, it has upper circuit and lower circuit, so your capital is quite safe in cash segment. But the movement in cash segment is very slow. Sometimes it moves around 5% in 6 months. In options, if you talk about, there are two types of options. First is stock option and second is index option. In index option, Nifty gave one lot at the price of 5,000, and if you are good in trading, you can earn up to 30% to 300% per month. But as we know, as I already said, options are risky. You can earn around 300% in a single day, as well as you can wipe your whole capital in a single day. They are highly volatile. In future, it is mainly related to stocks over in future, and you can also trade in futures of index. The lot size is very high. One lot cost around 1 lakh to almost 2 lakhs, and the movement in future is very slow. So if you are good in cash segment, then you can also become a good trader in future segment, and you can earn around 10 to 60% per month in future segment. In commodity, which consists of crude oil, natural gas, copper, gold, silver, their one lot size is around 55,000 to 2 lakhs. It is very expensive, and also the movement of commodity companies are very weird. Most of the time they move in a side trend and then suddenly gives big move, which make them very risky. You can earn up to 15% to 200% in commodity per month. Capital management. Well, as you know that if you have to trade and want to earn good profit, then you have to invest a large amount of capital, but your capital must be protected. If you get lost and your whole capital got wiped off, then how will you take trade next time? If you have a very good income of source and then you are trading without capital management, even then it will be risky for you, because there is a possibility that you will expend more than your income, more than your yearly income. Why capital management is necessary? Compare stock market trading to the cricket match. So in cricket, you know that when a batsman is started the match in cricket, in starting the batsman didn't hit boundaries. He takes singles and double, protecting his wicket, because he knows if he protect wicket for first 5 to 10 overs, then he will able to score more runs in the later overs. But if he lose his wicket early in the match and all the rest batsmen too, then who will score? That's the main problem in capital management. Even you, even if you are getting loss, it doesn't matter. If you have a good capital management, then you can recover your loss in the next trade. But if you wipe whole capital in a single go, then how will you recover that loss? So the best way to save capital is split your capital in 10 parts and only trade 10% of your capital. So if you get lost 3 times in a row, so almost 30% of your capital will be wiped off, but still you have 70% of your capital, then you have 7 chances to recover your loss. With time and experience, you will gain more accuracy than you currently have. So even if you get less number of profit, your profit size will be more than the size of loss. Risk management. This plays a very crucial role in stock market. Everyone has to know the importance of risk management. It is totally connected to risk reward ratio. Whenever you take trade in stock market, then there are 3 important things. First is entry, the price at which you are taking the trade. Second is stop loss, the difference between your entry price and your holding range if market goes in a reverse direction. And target, the price at which you are trying to book your profit. So the difference between entry price and stop loss is known as risk, and the difference between entry price and target is known as reward. So your reward must be greater than risk, almost 1:2 or 1:3 or greater than 1:3. Your reward must be almost double or more than double than the risk. It means if you are getting loss of 10,000, then you must earn 20,000 or more than 20,000 in a next trade. Otherwise, you can't recover your loss. And if you don't maintain the risk reward ratio, then there will be a possibility that you get 8 profit out of 10 and 2 loss, but your overall you will get only loss, because of the size of the losses is bigger than the size of profit. Same happens in reverse direction too. If you have a very good risk management and risk reward ratio 1:3 or greater than 1:3, and you get 7 loss against 3 profit, then there is a possibility that overall you are getting profit even with 3 profit and 7 loss. Cryptocurrency. Well, you have heard this name, and some people say that it is very safe and very easy to earn money in a very short period of time, and some people say it's just another bunch of a scam. So now you will get confused whether it is a scam or it is a legit It is not easy to decide, but I will tell you the reality of cryptocurrency. But first, you have to understand the basics of cryptocurrency, how it is different with other trading platform, and how it actually works. Digital currency. Cryptocurrency is actually a digital currency, and the rupees note, such as in India, or a dollar note in America, and other currency which are used in their respective countries. In their respective countries are the example of physical currency. Physical currency which you can see and store whenever you, whenever and wherever you want, like in your home or in your wallet, even in your banks. The currency is physical, but digital is not physical at all. It is just a value of any entity which can be increased or decreased according to the demand and supply of that particular entity. It is stored in digital form. That's why it is known as digital currency. The main thing is that physical currency is owned by the government, and government can decide the value of that physical currency according to the inflation or recession. But digital currency does not depend on government. That's why some government hates digital currency or crypto and ban cryptocurrency in their country. Well, cryptocurrency can also be used for stock market and as well as for digital payment for any entities. Everything related to crypto is a decentralized system, which means there is no authority or government which is controlling the system of crypto. It is just controlled by some nodes of computer built on blockchain, but not a single person can control or predict the cryptocurrency. Whereas in centralized system, if any index like in India, Nifty, Bank Nifty, Sensex, or index of other countries which are totally controlled by their respective government, they can decide when to trade, where to trade, how much you want to trade, and they can even allow or ban certain people. And most important, they can impose heavy taxes even on your losses. So in decentralized system, you are totally free from the government control. Blockchain. This is a technology which is used by cryptocurrency and which makes cryptocurrency more secure than a bank. Yes, you heard right. More secure than a bank. Every transaction related to crypto is recorded in blocks, and no one can alter or delete those records because those records are spread around internet on different computers. So it is impossible to change the data of cryptocurrency. Well, you remember the famous Harshad Mehta scam? He borrows large amount of money from banks, and just by manipulating the records of banks, those banks never get to know that huge amount of money is been leaking from their own banks. So hence proof that cryptocurrency is totally safe for transaction, but it doesn't mean then it is safe for trading. Now I will explain why. Because price manipulation in a stock market is happening since Harshad Mehta scam, even before that, and even today price manipulation is happening in Indian market as well as other market. Whenever there is a company whose volume is very less, then any big fund party can buy that stock and can control the whole movement of that stock. Then they create a scene of famous pump and dump just by spreading rumors of that company. Well, the main problem is that they are developing new technology and new strategies for price manipulation. So it is very hard for government to track them and prove they are guilty. For example, you remember the company named Luna in cryptocurrency. In crypto market, they scammed around billions dollars of their investors. Well, anyone with 1% of common sense can see the chart of Luna and can decide the famous pump and dump scenario. Even the famous person Elon Musk, when tweets about a particular company on the Twitter, the price of that company rises about 10% in a single day. And after some days, when he said that that company is not going to do well, and then again on the next day, that company falls by 10% in a single day. But Elon Musk earns billions in millions on both days, and all the followers get fooled easily. That's why Elon Musk bought the Twitter company. So now you can realize just that just by one tweet by a famous person can affect the movement of the stock market. And crypto market is the most volatile market compare as we compare if we compare with other stock market. So crypto market is for only pro traders who already have earned on different stock market, and if you are a beginner then just forget it. Never ever trade in crypto market. Forex trading. Now you have come in the world of trading. You also have heard about crypto and now forex trading. What is forex trading? So forex trading is basically a currency versus currency trading. Whenever you convert dollar to rupees or rupees to dollar or any currency in another currency, you will see there is a exchange rate. But if you do the same conversion after 1 hour, you will see the exchange rate has changed. So if you convert $1 into rupees, it may be around 82 rupees, and if you convert after 1 hour, it may become 82.40 paisa or 81.90 paisa. So people also trade on the movement of currency, which is known as forex trading. But the movement of conversion rate is very slow, less than 1.5%. So earning a big profit is almost impossible, but you get more than 500 times leverage in forex trading. It means if you have only 1000 rupees, you can trade at the amount of 5 lakh rupees. So your profit will be increased at the ratio of 500 times as well as your loss. It seems very helpful, but it is actually a very dangerous thing because people take full leverage without any experience in forex trading. So don't trade in forex trading until you are good in other segments of market. And the most important thing of forex trading is that forex trading has the highest volume among all other stock market platform. So stock price manipulation is very rare and almost negligible in forex trading. Another good thing of forex trading is that forex trading has a long hours of trading, and fundamental won't work well with forex, but technical analysis has a high accuracy rate. So if you are good in technical analysis and have experience in other segments of market, then you can trade in forex trading. Well, this is a chart of trading style which compares all the trading style of traders, and this trading style is based on time frame difference. The shortest time frame trading style is scalping, and as you can see, the trading time frame for scalping is very short. It is almost in seconds to minutes. Happens mostly in Nifty and Bank Nifty, like in index trading, because it has a very high volume and it moves very fast in options. So it is possible that you can double your money within few seconds. You get trading signals daily many times, and typically holding time is around some minutes. Chart interval you have to use 1 minute and 5 minutes. Trade monitoring, which means how much you have to monitor after you have taken the trade before exiting. Once you have taken trade in scalping, you have to watch it every second until the trade exit. Now the second style is day trading. Trading time frame is same day. You have to buy on the same day and you have to sell on the same day. Trading signals few and typical holding time is hour. Chart interval is 15 minutes or 1 hour. The best time frame for the intraday trading is 15 minutes, and yes, you have to monitor it after you have taken the intraday trading. Next is swing trading. Trading time frame is medium term, which can be around 5 days to 5 months, and trading signals you get very few on a weekly basis, and holding time can go from 5 days to 5 months. Chart interval we will use 1 hour to daily, and trade monitoring. Well, if you have taken the trade in swing trading, then you don't have to fully active monitor daily on swing trading. Next is positional trading. Trading time frame is long term. Trading signal very few in monthly or yearly, and holding time is around 6 months to 10 years or even more than that. And chart interval we use weekly or monthly for positional trading, and you have to really monitor for the positional trade because you have to hold it for around 6 months to 10 years. There is one another trading style known as BTST, buy today sell tomorrow, and the trading time frame is daily, and trading signal we get very few in a 1 month, and typical holding time is around 15 minutes for the first day and the 15 minutes of the second day, so around 30 minutes. Chart interval we use same as daily time frame, and in daily time frame we day trading same as day trading we use 15 minutes and 1 hour. And trade monitoring, you don't have to monitor the BTST, you just have to exit on the next day. In BTST we take trade on the last 15 minutes of the day trading and then hold until the next day market opens. So we actually are hoping for gap up or gap down. BTST for gap up and STBT for gap down. So we are actually doing gap trading. You get signal for BTST or STBT very rarely in a month, but whenever you get, this is the best way for trading because BTST can give a maximum profit in a minimum time. Technical analysis versus fundamental analysis. So in technical analysis, it focuses solely on charts and past price behaviors. Means is the technical analysis doesn't need any news, event or announcement regarding to that particular stock. While in fundamental analysis, it purely concentrates on the financial drivers of the economy itself, which means anything related to finance of that company or that country which can affect the movement of stock, that is considered as fundamental analysis. In technical analysis, trader will often incorporate indicators and tools. Traders use indicators like MACD, moving average, Bollinger Bands, etc., and other charting software which can provide additional information regarding to those indicators like candlestick pattern or Heikin-Ashi chart. But in fundamental analysis, traders will often follow news, announcement and data releases, which means any news related when any company launches anything or the result day or any two companies get merger or demerger, any kind of important announcement which can affect the movement of stock market is used by traders. In technical analysis, traders attempt to anticipate future price movements using past price behavior. Whenever they use indicators or other charting patterns, they try to predict future on the basis of that indicator, and they believe the same pattern will repeat in future, so that they can easily capture profits on that particular pattern. Whereas in fundamental analysis, traders totally rely on sentiment analysis based on news and economic data related to that particular stock or the country. For beginners trader, Money Control is the best website. Here you can get both technical and fundamental analysis of any stock. This is a candlestick chart, and you can change time frame with 15 minute, 5 minute or 30 minute, 1 hour, daily, weekly, monthly, or you can change the style of the chart. You can use line chart, area chart, or Heikin-Ashi chart. And here is the list of all famous indicators related to trading. Well, as you can see, if you use indicators like Bollinger Band, RSI, etc., and in current scene, as the RSI moving up, the price is also moving up. This is how we analyze indicators on chart. Now we will check some price action. The most basic price action is trend line. Observe carefully how the trend line is reacting to the stock prices. As you can see how well it is respecting the trend line, and it get bounce off from the trend line. Now we will check some fundamentals. Well, as you can see, in the year 2022, the revenue got almost double, and you can also see other things like income statement, balance sheet, cash flow ratios, etc. You can also check about the peer companies of that particular stock. Peer companies means the competition, because those companies are also giving the same product as beginner's trader versus professional trader. The beginner trader is afraid of risk, lacks knowledge in management and containment, which means if any beginners, when they start trading, the most problem is that they lack knowledge, and mostly they do very silly mistakes, and they don't do any kind of risk reward ratio management, capital management, or money management. That's why they get totally afraid in market and always do silly trading. But whereas pro traders never afraid of the risk, because they calculated every possibility of that trade, and they know how to manage and contain it. The beginner trader believes that they can get rich quick with trading. This is the most psychological problem of the new traders, because in trading you have to earn bit by bit. You can't get rich in a single night. Whereas the pro trader, they view the market as a game of probabilities, because they know when is the highest probability of getting profit and when is the less probability of getting profit. The beginner's trader other problem is their emotion control, which clouds their good judgment and leads to overtrading and panic, because whenever they get profit, they trade more and more and get excited, which leads to overtrading, and finally they get overall loss. And the second thing is panic. Whenever the market goes in opposite direction, they exit their trade even before reaching the stop loss. That's the main problem. Pro traders have no emotional attachment to a trade, because they know there is no need of emotions in trading, because trading is a game of probabilities, not emotions. Beginners traders freaks out when a trade moves even slightest bit against them, because 9 times out of 10 they have traded far too large. There is another problem, because their psychology is weak, and they don't know how to do a risk management. Whereas pro trader has a detailed trading plan and know exactly what they are looking for and when they are going to trade. As pro trader gives a lot of time in researching and planning, so even before taking the trade, they know how much maximum profit they can get or how much maximum loss they can get. To know more about technical analysis, watch my playlist on candlestick pattern and also on indicators.